Hey everyone, welcome to the OctaFX online workshop for complete beginners. This is the final episode of the workshop, guys, and we will be talking about risk management. Now, before I go over the talking points of this webinar, you can go ahead and type your name and where you're watching me from in the comments. So go ahead and type your name and where you're watching me from in the comments. My name is Ebuka Ambrose, and in previous episodes, we've talked about the fundamentals, how to predict the markets. We also looked at economic events and major events that happen in the market. So today we're going to be talking about risk management, which is very essential for you and I as a Forex trader. Okay, so type your name in the comments, and you can also go ahead to tell me if this is your first time participating in an OctaFX webinar. So let's look at the comments. Okay, so we have Joshua from Ghana. Legit says it's his first time. We have Dominic Ebiala from Abuja. We have Michael from Nigeria. Thompson David from Akwa Ibom. Raylin from Cape Town. Temba from South Africa. Princess from Nigeria. Inam watching from South Africa. Daniel from Lagos. Uchenna Precious from Italy. Massive welcome to you guys. Amit says he's watching from India. Thabo says this is my first time. Welcome. So what we basically do with these webinars is that we give you guys information and education on the Forex market. Kinsley from Anambra. Tumelu from South Africa says it's the first time. Tina from Nigeria, first time. Jonah John from Lagos. Patience from Nasarawa. Yeah. Welcome every one of you. So today we're going to be looking at risk management. Now, before I go in, let's just do the disclaimer. So any opinion, news, research, price analysis, or other information discussed in this webinar or linked to this presentation are provided as general market commentary and do not constitute investment advice. Trading is risky. So I'm going to talk about the bonuses that you can get for or from taking part in the OctaFX online workshop for complete beginners. The first bonus is 100% single-use deposit bonus per series. How do you get this? You sign up or confirm your participation on the OctaFX website, octafx.com, or you watch all the webinars from the series. You wait for an email from OctaFX confirming that your bonus is ready. You initiate a new deposit request and you claim the bonus for this deposit. Note that the bonus expires on the 3rd of August 2022. You also get a free trader's guide in PDF. If you watch all the webinars from the series, you stay active, ask your questions in the chat or answer my questions, you'd get your PDF handbook via email once the webinar is over. I'm seeing you guys. Raghu from Hindustan, Ola from Pakistan, Brenda from Owerri. Welcome every one of you. So what are you going to learn today? Topic is risk management. So you're going to understand what risk management is. We're going to talk about leverage. We'll also look at how to choose your risk to reward ratio and why you should use proper risk management in your trading. Okay, so in the course of this webinar, if you have questions, you can go ahead and type your questions in the comments. I'll be looking to answer your questions. We'll also have a section for question and answer. So let's dive right in. All right, so what is risk management? Now, risk management involves identifying, accepting, and mitigating trading decisions uncertainty. Risk management plays an important role in your trading journey as a beginner trader, since Forex trading entails taking considerable financial risk. Now, the main objective of risk management is to mitigate, the losses or unsuccessful trades from open positions should the market go against you. Right now, we have what we call fluctuations in the Forex market, and these fluctuations are driven by some fundamental factors, like the global economy and monetary policies. We also have geopolitical stability, market psychology, so technical factors, and speculation. These are factors that cause fluctuations and volatilities to the market. And with a proper risk management, you can encounter series of losses without blowing up your trading account. So basically, risk management are just steps and strategies that you apply to your trades so that you just mitigate the effect of an unsuccessful trade on your trading account. Now let's look at leverage. What is leverage? This is something that you would come across on your journey to being a trader or a successful trader. At the end of the day, before you create or during creating a trading account, if it's demo, if it's a real account, during that process, you would have to choose your leverage. Now, most of you don't understand what leverage is, which is why I'm going to explain that. So leverage is having the ability to control a large amount of money using very little of your own money. So the main advantage of using leverage is that it enables you as a trader to buy and sell extra units of currencies, commodities, indices, extra units of assets that you would otherwise not afford without leverage, right? So it helps you as a trader to make more profits with your trade than you would if you traded without leverage. So I'm going to give you guys like an example of the leverages that we have and what I mean by that extra advantage or that added advantage given to you by your broker. Okay, so just like you have this illustration here where you have $100 being on the same line with a $10,000 account because of the power of leverage, 1 to 100 leverage. I'm going to explain this in the next slide. All right, so the example here, someone says there is no voice. Let me know in the comments if you can hear me. If you can hear me, just go ahead and type in the comments that you can. Okay. All right, so I believe you guys can hear me loud and clear. Okay, so in the example that you see right now, we're using a $1,000 account balance or as an example, right? And we have different leverage options. Now, upon creating a trading account, you would come across, a place where you'd have to impute or choose your preferred leverage. Now, what does leverage mean? So we have one-to-one. Remember, it's an extra advantage given to you as a broker for you to given to you as a trader by your broker for you to be able to buy and sell more units of a currency, right? So we have one-to-one leverage. We have 1 to 10, 1 to 100, 1 to 500. With OctaFX, you have up to 1 to 1,000 or 1 to 2,000 leverage options, right? Now, the one-to-one basically means that your trading balance is going to be multiplied by 1, right? So in the ratio 1 to 1, 1 to 10, 1 to 100, 1 signifies your trading balance. 1 signifies your trading balance, and the figure or the number on the other side of the ratio signifies what your trading balance will be multiplied by. So 1 to 1 means that, I mean, for the example, a $1,000 account is going to be multiplied by 1, which is why you have 1,000 units in total buying power, right? 1,000 units in total buying power. Why? Because the trading balance 1,000 was multiplied by 1. Okay, and if you understand lot size, I mean, there's a video in the link in description, the English playlist where you can watch videos by OctaFX experts that explain lot size. But the value per pip for a micro lot size is 10 cents. Okay, and 10 cents, a micro lot size is made up of 1,000 units, which is why the value per pip of this 1,000 units you see here is valued at 10 cents. What this means is that every pip move is valued at 10 cents. Okay, I'll come to the 100% or minus 100% and plus 100% later, but let's go to the 1 to 10 leverage. Now, what this means is that, remember, 1 signifies your trading account balance. In this example, our trading account balance is $1,000, right? Okay, $1,000. Now, $1,000 was multiplied by 10 to give us 10,000 units in buying power, in total buying power. This means that I can buy or sell units of a currency worth 10,000, right? And the lot size, 10,000 units, is a mini lot size. So a mini lot size contains 10,000 units in total in buying power, right? Which is why the value per pip is $1. What this means is that every pip move for a mini lot size would be valued at $1. We'd also use this value per pip to get the calculation on, you know, the minus 100% that you see and plus the 100%. So pay attention, guys. So let's talk about the 1 to 100 leverage, right? So still the same calculation. 1 signifies your account balance, and 100 signifies, you know, what your account balance would be multiplied by. So 1,000 multiplied by 100 gives us a total buying power of 100,000 units, and 100,000 units is a standard lot size, right? The value per pip is $10, which means that every pip move would be valued at $10. And 1 to 500 leverage, the same calculation, your trading balance in this example, $1,000 multiplied by 500 would give us 500,000 units in total buying power, right? So this means that I can buy or sell 500,000 units of a currency, and the value per pip is $50. This is still a standard lot size. It's just that it's 500,000, which is 5 standard lot size. Okay, so value per pip for a standard lot size is $10. That means 5 standard lot size would be $50. All right, so the reason why you should pay attention to the value per pip is that it's also going to tell you how many pips you would make, or how many pips in profits you should make to get 100% of your trading balance, or how many pips you should lose to, you know, lose 100% of your trading balance, right? So without leverage, you would have to make unsuccessful trades worth of 10,000 pips, right? So you have to lose 10,000 pips in bad trades to lose 100% of your trading account without leverage. But you would still have to make 10,000 pips in profit to be able to make 100% of your trading balance. For example, we're looking at $1,000, right? So in order for me to make an extra $1,000 without leverage, that means I need to make 10,000 pips in profit, right? And for me to lose my $1,000, I need to lose 10,000. I need to make unsuccessful trades worth of 10,000 pips. That's without leverage. Now, with 1 to 10 leverage, I need to make 1,000 pips. You know, I need to make profitable trades worth of 1,000 pips in order to make 100% extra on this account balance that you see here. Because, I mean, my limit is 10,000 units in total buying power, right? And how did we get this 10,000 pips that you see, 1,000 pips that you see? What you just do is divide your trading account balance by the value per pip. That's all you do. You divide your trading account balance. In this case, we're looking at $1,000 as our example. So if I divide $1,000 by 1, this tells me that I need to make profit of 1,000 pips in order to make an extra 100% on my $1,000. For the 1 to 100 For the 1 to 100, the value per pip is $10. 100,000 units is one standard lot size, right? So just use the same formula. Remember, your trading balance divided by the value per pip. So $1,000 divided by 10 would give us 100 pips. What this means is that I need to make 100 pips in profit to get 100% of my trading balance. Same thing goes for 1 to 500. The same calculation. You divide your trading account balance by the value per pip, and then you get 20 pips. What this means is that I need to make 20 pips, just an extra 20 pips to get 100% of my trading balance in this example. Now, I just explained the 100%, right? If my trade goes, for example, if I use like a 1 to 500 leverage, and I go all in, I use 5 standard lot size, which is my limit, right? I can't use, if I use a 1 to 500, I can't use above my total buying power. So because let's say I'm a beginner trader, mistakes are not made by just beginner traders anyway, but let's say I decide to be greedy, right? I have 500,000 units in total buying power, so I can just go all in, expecting 100% gain to come in the next 20 pips. What if the trade goes against me? 20 pips. That means I can just lose 100% of my trading balance with 20 pips, right? If I decide to go all in, because I can use a 1 to 500 leverage, I have 500,000 units, so I can just go all in. You know, there are two sides. Leverage is a two-edged sword, right? It can expose you to greater chance of profit. It can also expose you to a significant loss. So I'm going to show you guys how you can take advantage of leverage to minimize your risk and also maximize your profit. Okay, someone is saying the terms are not clear. Like I said, there's a video in the link in the description. You can watch that after and come back to watch this one, so that you know, you can easily understand the terms that I am using. Okay, so like I said, leverage is a two-edged sword. More risk means higher chance of sizable returns, but also a greater chance of significant loss. So as a trader, it's important that you learn how to manage your level of risk to minimize loss and also maximize your gains. That's a skill that every trader must have, and I'm going to show you guys how to do that in the next slide. All right, so there's something we call risk to reward in Forex. It's basically how much you want to risk and how much you want to gain as profit from your trades, right? So how much do you want to risk on that trade, and how much do you want to make from that trade in profit? Now, this can be determined by two things, a lot of things, but mainly two things. The first one is market conditions. And the second one is a moderate position size. So that's how you choose your risk to reward ratio. You understand your market conditions, what is happening in the market right now. And the reason is because you can use a 20 pip stop loss for a trade today. Tomorrow, the market might give you conditions where you would be required to use a 40 pip stop loss. Okay, regardless of what condition the market gives. Your second option would be to use a moderate position size. Position size is also known as lot size. So your second option would be to, in the case of, you know, an increased stop loss level, you can use a moderate position size that can still keep you within low risk, 1% risk, 2% risk, right? So if the market condition requires you to increase your stop loss, maybe you're using like the ATR indicator, or you're using previous swing low to identify your stop loss, whatever it is, right? What I'm trying to say is that you may not always use the same amount of stop loss, the same amount of pips for every stop loss on the trade. Market conditions are dynamic, right? So what you can do is to adjust your position size to still keep you within the 1%, 2% risk of your trading account. Okay, so let me explain what I mean by 1%, 2% risk. All right, so we have risk to reward, like I said, and in this example, we're still using the $1,000 account balance as an example. So if my risk to reward is, let's start with the first one. Risk to reward here is 1:2, 1 to 2. What this means is that I am risking 1% to get 2% of my trading balance, right? So it's basically 1% of $1,000 is $10. And this is the calculation for that. 1,000 divided by 100 multiplied by 1, you get 1% of $1,000, right? And for 2%, the same calculation, 1,000 divided by 100 multiplied by 2. So for the first example, 1:2, it means I'm risking 1%, which is $10, and my profit is 2%, right? Like I said, market is dynamic. I mean, you could get market conditions where your take profit could be set at 3%, 4%, 5%, whatever market condition is. The second example is 1:3, which is I'm risking 1% to get 3%. So that's what I mean by risk to reward ratio, and this is how you can get your calculations for 1% and 2% of your trading balance. It's basic mathematics, guys, but you can just use this as a reminder so you don't forget. Now, your position size, I said something about choosing a moderate position size, a conservative position size. Your position size is the main tool to manage your risk. Yes, you have your stop loss, understanding market conditions, but at the end of the day, you open your trade with a position size, a lot size, right? So it's the same thing. Position size and lot size, they're the same thing. So that's the main tool to managing your risk. All right. Okay, so let me give you guys an example of how you can use risk to reward, or how traders use risk to reward. So one way that traders use risk to reward would be using 1% risk as an example. So one way that traders use it is as risk amount, right? So remember, you have 1:2, 1:2, 1:3 and 4, so one can serve as 1% of your trading balance. One can also serve as one, or whatever it is you want to risk, right? So one can serve as 1% of a trading account or trading balance. One in the ratio can also serve as whatever it is you want to risk. We're going to do the calculations together for the risk amount. We're also going to do the calculation for 1% of your trading balance, and you'd see which one is more conservative and which one exposes your trading account to lower risk than usual. All right, so the example, Michael and Kenneth has $1,000 in their trading account. So we have two traders, Michael and Kenneth. Each of them have $1,000 in their trading account. Right now, they place 8 trades. They place the same trades, it's the same trades, right? 8 same trades, and the win rate after these 8 trades is 50%, and the result of the risk to reward is 1:2, 3, and 4, right? So Michael decides to risk $250 on a trade, and Kenneth risk $20 on a trade. Remember the example, 1 as risk amount. So we're not using percentage right now. So this is their decision. They're using 1 as their decision. What this means is that if Michael is risking, if Michael's 1 ratio risk is 250, then his 4 would be 250 multiplied by 4, which is $1,000, right? So if he's risking 250 to get an extra, 4 in rewards, he's basically going for $1,000, right? If he's risking 250 to get an extra 2, then he's basically going for $500, right? Same thing for Kenneth. Kenneth chose to risk $20. So if his reward is extra 2, then his reward is going to be $40. If his reward is extra 4, his reward is going to be $80. So this is like an example for traders that use 1 in the ratio as the risk amount, right, as their preferred risk amount. So the result after 8 trades The first 4 trades were unsuccessful. So Michael, he's risking $250 on a trade. Remember, both of them have $1,000, right? Both of them have $1,000. So Michael is risking $250 on a trade. The first trade unsuccessful, minus $250. Second one, same unsuccessful, minus $250. He has 500 left. The third trade unsuccessful, minus $250, and the fourth trade unsuccessful, minus $250. And the remaining 4 trades were successful trades, but Michael did not have enough money in his trading account to place that trade. Kenneth, on the other hand, he chose to risk $20, right? So first trade unsuccessful, minus $20. Second trade unsuccessful, minus $20. He still has $960 left. Third trade unsuccessful, minus $20, so he's down $60. And the fourth trade unsuccessful, minus $20, so he has $920 left. He's lost $80. Now the remaining trades were successful: $40, $60, $80, and another $40. Remember, the results were 1:2, 3, and 4, right? So Kenneth still had $920 in his trading account to place new trades, and his new balance was $1,140 rather. Now, the essence of minimizing your risk is, guys, we're trading to trade another day, right? We're not looking at making all the money in the market in one day. And losses are an integral part of trading. This means that you're not guaranteed that every trade you place from the first day of the year will be profitable till the last day of the year. So you want to focus more on minimizing your risk, protecting your capital, and maximizing your returns, right? Okay, so that is the example for 1 in the ratio, 1:2, 1:3, 1 as your preferred risk amount. Now let's look at 1 as percentage from your account balance, right? We've looked at 1 being preferred amount to risk. Now let's look at that 1 in the ratio as 1% of your account balance, right? So the same example, the same trades, but this time we would be calculating this based on 1%. Okay, so we still have Michael and Kenneth in this example, and they've been given $1,000 in their trading account. Now they place 8 trades, the same trades, and the win rate after these 8 trades is 50%, right? And the risk to reward is 1:2, 3, and 4. Now, they've decided to risk 1%. So 1% of $1,000 is $10. Right? So Michael and Kenneth risk $10 on a trade. Both of them, they decide to risk $10 on each trade, and the result after 8 trades, the first 4 trades were unsuccessful, the last 4 trades were successful. So for the first 4 trades, they both lost $10 in the first trade, lost another $10 in the second trade, lost another $10 in the third trade, and lost $10 in the fourth trade. So a total of $40. So they still have $960 left to place more trades. And the remaining trades were profitable. So $20 added to $960, 30, 40, 20, and the final balance was $1,070, right? So at the end of the day, they've minimized the risk by using 1% as their trading balance, by risking just $10, reducing the amount that they want to risk on a trade, right? So 1% of $1,000 is $10. Both of them chose to risk $10 on a trade, and now that has given them more room to place more trades. Okay, yes, trading can be risky, but it's riskiest if you don't manage your risk at all. At the end of the day, it's all about decreasing your exposure to risk in whatever form it may appear. Okay, so these are the two examples. Now, whichever one you choose to do, if you choose to use 1 in the ratio as your preferred amount, it's important that you just risk 1 or 2% of your trading balance on a trade. So you can just do that so that you have more money to place more trades and your account just stays healthy. Okay, all right, so let's talk about why you should apply proper risk management to your trades. If you don't trade, you're not going to make money, yes, but if you lose all your money trading, then you can't even trade to make money. So this is why risk management is very important. And yeah, I'll just go over it right now. So Forex risk management enables you to implement actions to ensure any negative impact of a trade is manageable. Right, so Forex risk management enables you to implement actions and steps and strategies to ensure that if your trade goes against you, the impact or the negative impact on your trading account is manageable. An effective strategy requires proper planning from the onset. It's better to have a risk management plan in place before you start trading. So you don't just come into the market and you're clicking buy and sell and you start hoping for the market to move in your direction. Guys, hope is not a strategy in Forex. You can't hope. You can't hope, right? So it's important that you look at what the market is doing at the time, understanding market conditions, like I said earlier, and then you determine your risk right there before you choose to place the trade. You already know how much you want to risk on this trade and you're comfortable with it, right? So a proper risk management would minimize effects of negative trades. That's one, and it will keep you in the market longer. So let's say let's use the $1,000 account as an example, right? So let's say I have $1,000 in my trading account, right? And I don't use proper risk management. I just come to the market and I trade blindly, right? And I lose $500 in just one day. I've lost 50%, right? Now, for me to get back to $1,000, I need to make 100% of what I have left. So if I lose $500, that means I have $500 left. Now I have to make an extra 100%. What I just lost was 50%, but now I have to make 100% of what I have left, which is $500, to get back to my initial startup capital. So I think this explains why you should apply proper risk management to all your trades. Because at the end of the day, I mean, as a trader, you want to be able to trade next week, next month, next 2 months, right? So I mean, why focus on getting all the money in the market today and just being greedy when you can use conservative lot size, use a moderate risk to reward ratio, have a plan that would give you consistent profit over time, right? So it's important that you focus on having a plan that would just developing an edge over the market that would give you consistent profit over time, because at the end of the day, the market pays those that are consistent with the strategies. And it's not you don't just come today and make all the money from the market and you're rich the next day. Okay, so having a plan is important. Applying proper risk management to your trades is also important if you want to stay in the market longer. All right, so let's look at some risk management tips that you can apply to your trading. Some risk management tips that you can apply to your trading. The first one would be to get an adequate knowledge of the Forex market and its risks before trading live. So you can learn and understand how the market works. You can also backtest new strategies on your demo account before trading on a live account. So whatever it is you learn, you can use your demo account, which is why you have a demo account, right? Demo account is free. You can start trading with the link in the description as well. So use a demo account to practice whatever it is. Let's say you come to the OctaFX YouTube channel, you learn some strategies, some new things that you've learned. You can go over to your demo account to practice what you've learned, get that confidence. The demo account will just immerse you in a positive environment so you get familiar with trading tools and market conditions and get that confidence and comfortability that you need before trading on a live account. The third one would be to understand the impact of leverage. Guys, like I said, leverage is a two-edged sword, right? It can give you massive returns. It can also expose your trading account to a significant amount of risk, right? So you understand the impact of leverage, and you use proper or moderate risk to reward ratio, use stop loss and take profit, use a conservative lot size to minimize the effect of these negative trades, right? The fourth one is to work on your risk appetite. Risk appetite is basically a certain amount that you want to risk on a trade. Just like I said, we had the risk to reward ratio where some examples were 1:2, 1:3, so one can be 1% of a trading account. One can also be an amount that you choose to risk on that trade. But like I said, you can keep your risk amount below 2% so you can have more money to trade, right? So my risk appetite can be 1%, my risk appetite can be 2%, someone else's risk appetite can just be 2% flat. So understand what your risk appetite is and work on it. The fifth one is to use a moderate position size. Position size, like I said, is just the same as lot size, right? So you can't be 100% certain on a trade, and it's important that you use a moderate position size. I love to call it lot size anyway, but it's important that you use a moderate or a conservative lot size on your trades so that you don't expose your trading account to high level of risk. Like I said, your lot size is the main tool to manage your risk. The sixth tip would be to set your preferred stop loss and take profit level on your trades. So a stop loss basically tells your broker, it's an automatic order, actually an instruction that tells your broker to stop you out at a certain level or your preferred level if the market chooses to go against you. So it just halts further advance in loss. So it just stops you out right there so you don't lose more than you want to. And your take profit secures your profit at your preferred level, right? And it's important to use this because you don't just want to open trades and let the trade float without having a specific target, right? You should have these levels even before you open your trade. You should identify where you want your stop loss to be and where you want your take profit to be. And you can use the swing lows, you can use your candlestick patterns, you can use the 8-hour indicator to identify that for the stop loss. And the seventh tip would be to choose a moderate risk to reward ratio. I know that you understand risk to reward ratio as 1% risk, 2%, but you see some traders use 1% to get 20%. I mean, that's not bad, but if you don't understand the market conditions, you wouldn't even know if the markets can give you that 20%, right? So you're not certain on the exact percentage that you can get from a trade. So except you're seeing some levels and some important area of value in the market that tells you this market could potentially get to this point, you don't have to make your risk to reward unrealistic, right? You don't have to do like a 1% risk to 50% profit when the market doesn't tell you that, okay? But whatever it is you choose to do, whatever risk to reward ratio you choose to follow, just make sure you practice on a demo account, and then you're comfortable with your chosen risk to reward ratio. It can be dynamic at some point. You may not always get a certain percentage out of every trade, okay? The next risk management tip would be to use a trailing stop on your trade. Use a trailing stop on your trades to protect your profits. So a trailing stop is basically when your trades are in profit, and now you can move your stop loss into profit so that you can just secure a certain amount of profit. That can only happen when your trades are in profit, right? When your trades are in profit. And if you're using a risk to reward ratio, let's say like a 1:5, a 1:7, I mean, if you achieve 1:4, if you achieve a 4% return on that trade, you can just set your stop loss to like 3%. You can secure some profit so that if the market reverses, you don't lose what you would have gotten as your profit. Okay. The next risk management tip would be to control your emotions and do not over trade or revenge trade. And this is something that you can really do with a demo account as well. Practice on how to control your emotions. You don't have to over trade. Over trading is basically just placing multiple trades. Like I said, you can't be certain of a certain percentage that the market is going to give you, right? And revenge trading is basically when you probably lose a trade, or you don't make profit from a trade, and then you want to make the money back on the next trade, so you go big with the lot size, or you open multiple positions because you want to revenge trade. Guys, you need to be thinking with or you need to be trading with a practical mindset, a clear-sighted mind. I mean, you're dealing with figures, right? So you don't want to just trade blindly or revenge. Okay. The 10th risk management tip would be to know when to stop after consecutive wins. Know your victory mark, right? So you could trade like 3 times in a day and you make profit from those 3 times. You see traders start feeling like they're masters of trading now, so they can continue to trade and open more trades. Just have, and this is why it's important to have a trading plan that tells you when to stop, right? If you've achieved your targets for the day, you can just stop. You trade the next day. There would always be opportunities to trade the forex market. The market is always going to present new opportunities. It may not come every single day, but opportunities would come, right? So know when to stop after consecutive wins. Yeah, and never risk more than you can afford to lose. Like I said, you can risk 2% or less on a single trade. The main idea behind risk management is to reduce your exposure to risk in whatever form it may appear. Okay, so these are 11 risk management tips that you can apply to your trading. All right, you can have a winning strategy, but without risk management, I mean, you can still blow up your trading account. The best education for a beginner trader is a risk management, and it's important that you understand how to minimize your risk on every single trade. Okay, so that's it on risk management. Like I said, it's the final episode of the online workshop for complete beginners, and we are in the Q&A session. So if you have questions, you can go ahead and type your questions in the comment section. I'm looking at the comment section right now to see if there are questions. So go ahead and type your questions right now. Where's the actual point to pin the stop loss on the chart? What strategies should be deployed to specify stop loss or take profit order? The easiest way, or let me not say easy, but yeah, easy to identify, yeah, is market structure, right? Swing highs and swing lows. You can also use candlestick patterns. There are cases where you'd need to you need to identify the previous swing low or the previous low of the candlestick to identify where your stop loss should be. I mean, if you identify like an evening star pattern, a candlestick pattern in the market, it's made up of 3 candlesticks, right? So you can use the low of the middle candlestick in the evening star as your stop loss for your trades. You can also use the ATR indicator to identify your stop loss. Well, someone with $100, you can use a micro lot size, 0.01. Right, like I said, it's about minimizing or reducing your risk in whatever form it may appear. So with a 0.01 lot size, the value per pip is 10 cents, right? So 10 pips will be $1. But it also depends on market conditions as well. You know, there are cases where there are cases where you would use 20 pips, 40 pips, you know. I want to know if I'm the one to put the amount I want to trade with, or the broker will show me the amount. You decide. If you're trading with OctaFX, OctaFX doesn't trade for you. You decide. What's the best session time for trading in Forex? So we have 4 major sessions, right? Sydney, Tokyo, New York, London. I wouldn't say any one of them is the best. You can just come at this exact session and make money, but I would say you can trade when 2 sessions are open, because the market tends to be volatile at that time, and volatility is what gives traders money. You need the markets to move so that you can make money. So you can take advantage of volatility when 2 sessions are open and look for opportunities that you can trade. All right. Okay, so since we're out of questions, someone says explain liquidity. Like I said, there's a video in the link in the description where you can find videos by OctaFX experts that explain that. You can go to the English playlist in the online workshop for complete beginners. I think the second episode, we also explained liquidity and types of liquidity. So you can check that out so you can understand what liquidity is. So I'm going to test your knowledge, right? So I want to be sure that you guys understand what you have learned today. So let's do a quick brain test. Now, if you know the answers to these questions, you can go ahead and type the answers in the comment section. The first one is, what is the total buying power for a 1 to 2,000 leverage on a $100 trading account? What is the total buying power for a 1 to 2,000 leverage on a $100 trading account? You can type the answer in the comments. Johnson Namdi says 200,000 in total buying power. Okay, well, that's the answer. Remember, when you're looking at leverage, 1 in the ratio signifies your trading balance, right? So it's just going to be multiplied by what you have on the other side of the ratio. In this case, 100 multiplied by 2,000 is 200,000. So Johnson and Amdi correct. Thank God, Ayenemi 200,000 correct. Patience Easy 200,000, that's correct. So the second question, what is the value per pip of 2 mini lot size? What is the value per pip of 2 mini lot size? know the answers, you can type in the comments. The value per pip of 2 mini lot size. Okay, my cow says $20. Patience Easy says $2. CG World says $200. Thank God says $2. Johnson and Amdi says 20 cents. So the value per pip of 2 mini lot size is $2. 1 mini lot size, the value per pip of 1 mini lot size is $1, right? So 2 mini lot size is $2, and it's identified as 0.20 on your trading app. So you have lot size, it's 2 mini lot size is 0.20. Third question, 5:1 is a good risk to reward ratio, true or false rather? 5:1 is a good risk to reward ratio, true or false? Where 5 is the risk and 1 is the reward. Is that a good risk to reward ratio? Let me know in the comments. Jonah John says false. Otaka Emmanuel says true. Godwin says false. Johnson says false. CG World says false. Well, I mean, if you're risking 5% and your reward is 1%, that's not really a good risk to reward, is it? Your risk is 5% of your trading account. So the answer is false anyway. And the final question, what risk management methods would you apply on your trades? What risk management methods would you apply on your trades? Let me know in the comments. What risk management methods? You know, I gave you guys 11 risk management tips. So let me know which of these tips you would apply on your trades. No, I didn't say risk to reward. I'm talking about risk management methods, not risk to reward. I want to give you guys a hint, but let's see if one person answers correctly first. 1:2, 1:2, 1:3, those are risk to reward ratios, yes, but what risk management methods would you apply in your trades? Godwin says setting stop loss, you know, applying stop loss on your trade. That's a risk management method, and it's not just about using a stop loss, right? You need to identify your stop loss level and make sure it's within, you know, a reasonable amount of risk, right? So you don't want to use a stop loss that you would set at 50% risk of your trading account. I mean, yes, you're using the stop loss, but is the risk good? You know. Levine says don't overtrade. All right. Vivian Carlo says using the right stop loss and take profit. Rago says using a trailing stop. Dayo says never risk more than I can afford. Michael says not revenge trading. Thank God says moderate position size. Heaven says get adequate knowledge of Forex. And CG Word says understand market conditions. So these are actually risk management methods that you can apply on your trade to minimize the exposure to risk, you know, of your trading account. So it was a beautiful and awesome online workshop for complete beginners. We've had 4 episodes in this workshop, and the first one was Forex fundamentals, second one was first steps in trading. We also looked at predicting the market and risk management, which, you know, we talked about today. So you can find the video in the link in the description. And thank you guys for participating in this workshop. I'll see you guys next time.